All right, let's do a quick sound check. Hey, what's up, guys? Quick sound check in the free room, and we'll get the party started for Wednesday, September 7th. Hey, Mirza, good morning, Miss Mandy, Miss Lorna, Big Dog, Andrew, Austin. Hey, I feel you, Austin. Free is good, especially in today's world. All right, guys, we're good to go. We have got about 45 minutes until the cash market opens, so we'll dive on in here. It's hopefully you're getting some better weather than I'm getting over here in Massachusetts. Cloudy and rainy, so I got to bring my own energy today. But for the market here, guys, I mean, it's all kind of straightforward. Where the structures are busted. I mean, actually, here's where we're going to start, because I think we all got a pretty good grasp of, hey, the market made a big rip, right? And that was a lot of fun. So that did present a lot of opportunities. This is where things, should have held up on that dip to that 21 EMA. And of course, the market has since rolled over. So I think, at least from my perspective, pretty easy to look at a daily chart and say, yeah, path of least resistance is to the downside. So I want to short the bounces. I even think on a weekly chart. Okay, we rallied up to the weekly 50, gave that a little smooch, a little smooch on the cheek, and then we rolled over. We're back under the 21. Okay, I can look at that weekly chart and say, looks like I want to short the bounces. Here's what I think is super interesting. Give me a second here. QQQ. I did cover this in the weekend video. Let's do this. Studies. Check this stuff out, though. Moving average, exponential. Hang tight. All right, we got the 8 EMA. Let's get rid of everything else. All right, no Keltner channels, no 50 SMA. There we go. All right, so 21 EMA, 8 period EMA. So here's what's super interesting. I want you guys to focus on two things. Focus on the positioning of those two moving averages, and then focus on the squeeze histogram. And I don't think these are things we want to ignore. So, what we're seeing right now in the QQQ, and the S&Ps are getting pretty close. And then if you go through the financial sector, the semiconductor sector, a lot of things in the market starting to show, a pretty big shift of trend on the monthly chart. So right now for the Q-tips, you have the negative moving average cross. Right? So the 8 period EMA going under the 21 period EMA. And then on the squeeze histogram, the histo has gone negative. Bullish momentum, exhaustion of that bullish momentum. Now things are getting bearish. So what I think is super interesting is, here's COVID. And of course, COVID was a pretty big flush. Neither of these things happened during COVID. The histogram actually gains momentum. The 8 stayed above the 21. Right? So even that whole COVID flush didn't really cause any damage to your monthly trend. You could actually look at the monthly chart and just say, that was kind of a standard pullback at the 21 EMA. Right? So COVID does no damage to the monthly trend as far as structure or as far as momentum goes. Back here in 2018, pretty good sell-off, but the 8 stays above the 21, the histogram stays positive. So the last time that we've seen this, the negative moving average cross and the negative histogram, we is going all the way back to 2008. Pretty big time stuff here, guys, right? Every pullback in the market, every bear market period up to this point has not really caused any damage to that monthly trend that really started after 2008. From a bigger picture perspective, that's where a lot of this party started in terms of your 8 gets back above your 21, your histogram goes positive. That's been the case ever since, up until now. So make sure you keep that in mind because, you look at a daily chart, yeah, this looks pretty shortable, but we've seen this before. The weekly chart, I think, looks shortable, but we've seen this before. What we haven't seen since 2008 is a pullback in the market that actually starts to cause some structure and momentum damage to your monthly trend. So I don't think you buy, 150 puts on the QQQ necessarily, but as we're trying to build out our list of reasons to think the path of least resistance is to the downside, now I think you got the monthly charts starting to point towards, yeah, if we can't clean this up pretty quick, it's a major shift in trend that I don't think we want to ignore. So I, for one, find that all pretty interesting. But now, as far as where we are today, this becomes a tricky spot, guys. I do think eventually, and it could happen pretty quick, but I do think eventually we're going to come down and test these lows, and then I think we go a little bit lower. But for now, that's kind of the immediate target to the downside. So the big question is, here's point A, and then here's point B, down at your June lows. The question is, as we go from point A to point B, does this just happen in a straight shot where the market totally gets spanked, down we go? Or since we're a little bit oversold here, the Qs are hanging out like at -3 ATR on the daily chart, being that we're a little oversold, can the market trigger some kind of short squeeze that I highly doubt reverses this pattern? But if anything, you get a little pop towards your 50. At that point, the 50 probably lines up with the 21. Some sort of pop, shake out a few of the shorts, and then we roll over back down towards those June lows. Of course, we don't have the answer to that question just yet, but the point being is be a little cautious getting short down here. Here's how you really want to look at it. Very much like up here. It's not to say you can't get long up there at 2 to 3 ATR. What I think you can't do is get long in a fashion where if the market does in fact pull back, it's going to cause you all kinds of damage. So I don't think at 3 ATR we want to buy, delta 20 calls, 15% position size. That can all get pretty painful. So the same rules apply on the downside. I think we're headed back towards the lows. It could happen next week. But I don't think you want to get short here in a fashion where if the market, lo and behold, does rally a little bit before rolling over, you don't want that to be super painful. So I'm thinking if you can't resist the temptation to get short here, consider doing something like an October, November expiration call credit spread. Structure a trade that has plenty of time till expiration, but an out the money call credit spread, it's a little bit easier to sit through than deep out the money long puts. So we'll take a quick look here at the futures. But as far as my overall game plan, guys, that's about it. And personally, I'm not really trying to short the Teslas, the Googles, the Amazons. As goes Mamacita S&P, typically goes the rest of the market. So we're shorting the bounces for now. The only short we have on the board for the time being is this October 21st expiration, deep out the money call credit spread. So we took this on Friday. We sold the 4,100 calls, and we bought the 4,125s as protection. But there's the timing component. Right? We're putting that trade on Friday up here. You're going to lock in a much better risk reward. And if you're shorting the S&Ps at 400, it's not that painful sitting through a bounce to about 405. You short the S&Ps at 390, then a rally to 405. You're going to feel all 15 bucks of that. So we got the SPX short for now, and for the futures here, quick peek. I mean, that's the line in the sand, right? If we get a big close under 3,900, then the way I see it is who's going to buy that until we at least get back down to support. Yeah, I think kind of tough to think, you get a bunch of buyers coming in up here in this range. So if we break here, I think we got a pretty good express route down towards the recent lows. So keep a close eye on 3,900. But the futures, guys, they're pretty quiet here. So not too much context to take from that. So there's the short side. And I do think for now, for a swing trader, that's going to be your bigger plate of opportunity. Just be cautious. We could potentially get a little bit of that short squeeze action going. You break 3,900, down goes Fraser. So for the upside, the elusive upside, let me show you guys a couple of things here. Coming into the week, the only thing I really considered, potentially keeping an eye on for some bullish trades was energy. So let me do this real quick. We'll do multi-big three. All right, Beauteous. So for energy here, this certainly has a much better structure than a lot of things in the market. Better structure than the S&Ps, the Qs, the semis, big tech. So not a bad looking daily chart. But the whole idea, if we're going to take that bullish entry at that 21 EMA, the whole idea is ideally 2, 3, 4, maybe 5 days later, we're cashing out and taking profits on that push towards 2 ATR. So that's really the moment in time we're trying to catch. Sets up at the launching pad. A couple of days later, we're taking liftoff. So what I'm learning more and more as of late, and I'm kind of thinking for those of you in my mastery, we might end up doing like a Sunday special, kind of doing a deep dive into all of this. But the thing is, guys, what you want to study is what your lower time frames look like during that explosive push. Because a daily chart is all pretty straightforward. We're either on top of the 21 EMA or we're not. But the real question is, okay, once you find the stock on top of that 21, what really triggers that huge move towards the upside versus, what triggers something like this? Oxy pulls back to the 21, finds some pretty good support, but then it all gets a little bit sloppy. And the difference is the quality of your lower time frames. So for like 7 or 8 years, my major focus has always been weekly and daily charts. But with the big three indicator, that's kind of forced me to spend a lot more time looking at my 4 hour, my 2 hour, my 1 hour. So what I'm learning here, guys, is that your daily structure, your daily chart kind of sets the tone for the potential move. Where if you find a stock in an uptrend, we're probably thinking a bit more so, okay, that's probably going to move to the upside. But the thing you want to study, right, so we can avoid getting caught in traps, and so we can do a better job of getting long when things are, locked and loaded for that explosive move. The thing you want to study is what's going on in the lower time frames. Again, a daily chart, it is what it is. You're above the 21 EMA. Where do we go from here? Or do we just get long every time something hits that 21? So we'll focus on the hourly chart, right? Take notes on what the hourly chart looks like during that explosive push off of the 21 EMA. And we're going to just single out the hourly chart here. Understand it's basically everything under the surface. If we're really going to nail the timing where we can get long and then pretty quickly, there's that big push off the 21 EMA. This is ideally what you're looking for under the surface. And if you guys have the big three indicator, that basically does the job for you. But at a basic level, compare the current hourly chart on Oxy here to the hourly chart back here, both before and during that explosive move. Don't even focus on the Keltner channels. Don't even worry about the big three signals. Just a few basics. Back here, you're above your hourly 21 EMA and you're above your hourly 50. Your hourly chart's got a good solid foundation. Right? It's got some structure to it. There's some structure to it that can potentially trigger that move towards the upside. So to use an analogy, it's kind of like, all right, here's the volcano, but it's just kind of a volcano. Right? We're staring at this big giant thing that could explode, but how can we really get a good sense of, okay, here comes the eruption, or this is just kind of dead in the water, there's not going to be too much happening here? I think it comes down to the quality of your lower time frames. Right? So imagine on top of that 21 EMA, the 4-hour chart, the 2-hour chart, the 1 hour, 30-minute, 15-minute. They're all locked and loaded with good structure. Well, then you've got a chance for that move off of the 21 EMA. So when I look at Oxy right now, for conversation's sake, let's just pretend it's actually holding above that 21 EMA. Before I jump in here, I got to go run that check on the lower time frames. That's not it. I can't look at the hourly chart under the surface and have any confidence this is gearing up for an explosive move, because that's what it should look like. So should the 30-minute, the 15-minute, the 2-hour, etc. So from this perspective, right, if we're really going to try to nail these things when everything's lining up, the problems for Oxy as far as, hey, let's be a little patient here, let's not jump in just yet, those problems actually start back here. Right? That gap down back there, see that gap? That gap didn't cause any problems. That's a great buy the dip opportunity. Above the 21, above the 50, we got some buy signals. This gap was totally different. That gap put a serious dent in the structure of your hourly chart. And of course, everything else as well. So hopefully that makes sense, guys, where, let me do this, right? Flexible grid. So now I got this chart layout here where we have the daily, the 195, right, / 4 hour, the 2 hour, the 1 hour, the 30-minute, 15-minute, 5-minute, 1 minute. So let me think of a name here. ExxonMobil. Right, so if I look at the daily chart, come on, Exxon, don't be shy. It all looks pretty standard, right? Daily squeeze, we're above the 21. So how can I distinguish, or no, how can I make that call? Is there a really high probability ExxonMobil's about to do that? Right, huge move off the 21, or is there a better probability this is all going to get a little bit sloppy? Go study your 15-minute, 30-minute, 1 hour, 2 hour charts during that kind of push. And then go study your 1 hour, 30-minute, 2 hour charts during that big mess back here. And sure enough, what you'll find is hourly chart lost its structure. So basically, guys, it's like you got to take these things, you got to give them an X-ray. Okay. Right now, from a daily charts perspective, Exxon holds up pretty good. It kind of looks pretty similar to back there. You give it a couple of X-rays, right? You run it through a couple of tests, pretty quickly it's like, it's not all that healthy under the surface. Right? It looks pretty good, but we're under the 195-minute 21 EMA. We're under the 2 hour. We're under the 1 hour. We're under the 30-minute. We're under the 15-minute. We're under the 5. How could I possibly think ExxonMobil was about to explode when on every explosion, your 15-minute, 30-minute, hourly chart, etc., are the total opposite? So we'll talk more about this in the upcoming sessions, but as a trader, you're always trying to find little ways to tweak your game, right? Little tweaks to make to improve your game. And even if something like this can improve your game, 1%, it adds up in the long run. So with this kind of, focus on, okay, the daily chart kind of sets the tone, but what actually triggers the party are those lower time frames. I think with this focus, it's going to do a couple of different things for me. One, it's going to get me into things that are higher quality. So now the probabilities game is working in my favor a lot more. And I also think it's going to help me avoid things that might look okay, but then turn into a problem. Right? So XLE, am I going to buy that here at the 21 EMA? Well, let me give it an X-ray or a CAT scan, whatever. Okay, energy under the 195, under the 2, under the 1 hour, under the 30 minute, under the 15 minute. Yeah, I'm going to pass for now. Back above the 195, back above the 2 hour, etc. Then we've got something to work with. But I think we're in a market right now where this is really important because NVIDIA, UNG is another good example. Things can look really good. And then almost like in the blink of an eye, things really start to break down. So sure enough for UNG, it's like, what happens here? We got the big push going. Basically, you can do no wrong getting long UNG. Then the hourly structure starts to go to crap. So with that kind of focus, you start to see the problems here under the surface way before UNG gaps down 8% yesterday. You're seeing those problems under the surface up here. And in comparison, throughout that entire push, everything on your lower time frames, picture perfect. So that's kind of a segue into me saying I came into the week open-minded to getting long energy. This has got to play a little bit of cleanup. In other words, guys, not enough for me to want to get long simply because something is trading above the 21 EMA on the daily chart. If I can find something on top of the daily 21 EMA, but then every other time frame is on steroids, okay, perfect. So things to consider there. Now you can take the same mindset to the downside. Same mindset. But that is all I got for you guys this morning. Bigger picture game plan is short the bounces into resistance. And, for the next couple of days here, and today's Wednesday, that's right, we got a short week. Next couple of days here, 390 is line in the sand. So be careful here. If you're going to get short, you get short in a fashion where if you got to sit through a little bit of a bounce, you want to add a bit more. So I'll jump in the chat here, guys. We got about 10 minutes or so before I got to bounce to the options room. But real quick, of course, the dollar. There's a chart on steroids. So it's going to be really tough, for the S&Ps and the Qs to get any kind of meaningful bounce going, as long as the dollar here is pumping away. HYG, the junk bonds. My assumption would be HYG makes a new low. The S&Ps and the Qs are not too far behind. The volatility index. One would imagine this breaks through 28. Selling pressure probably picks up a bit. And then two more things for you guys. Keep a very close eye on Apple and Tesla. Right? Two very heavily weighted stocks as far as the indexes go. If Apple really starts crap the bed, it's doing a little bit of that. But if Apple really starts to break down and Tesla starts to break down, no bueno for the overall market. So that's what I got for you guys. Let me jump in the chat here, see what you got for questions. And then for those of you in the options room, I'll be taking y'all through the open this morning. Yeah, Delta 50, David, I'll give you kind of a quick rundown of the big three indicator. So Eric is our indicator mastermind here. So David, what I did was I basically gave Eric my bullish and my bearish checklists. Like, hey, Eric, here's the 4 or 5 things that have to come together for me to look at a time frame and say, yeah, that's bullish. That's perfect. Path of least resistance is to the upside. He took those, 4 or 5 things and basically turned it into an indicator. So it's basically my checklist in the form of these utility labels. So yellow is just neutral. Doesn't fit my bullish criteria, doesn't fit my bearish criteria. Not too much I can do with that. Something like the dollar, of course, incredibly bullish right now. It's got the full bull stack. So the daily chart down to the 5-minute, they fit all my bullish criteria. So that incorporates things like, the stack MAs, the 10x bars, the squeeze signal, moving average positioning. Takes all those things and spits out a signal. So, David, say I'm going to short the rally into resistance. Typically only looking to do that when we've got some sell signals. So the SPY right now, we have 1 hour, 30-minute, and 15-minute sell signals. And if I'm going to buy the dip in something, ideally we got a bunch of buy signals. So it's kind of a quick rundown. Yeah, Andrew, we got the red beans everywhere. Bunch of red hot chili peppers here this morning. Good morning, Miss Janice. Good morning, Sebastian. MW. Oh, Jerry, you're out in Springfield. Yeah, I got to make a trip out there soon. I want to go to the I haven't been to the Basketball Hall of Fame in a long, long time. But I'm pretty sure they got a Kobe Bryant thing over there, so a road trip is in order at some point. Tom, I think you'll find in our options room, we got a lot of folks in the options room doing trades like that. A good example was actually yesterday morning. Johnny Carts, he came in. He did the open yesterday. What did John do yesterday? He played this bounce. I think they did a quick put credit spread. They were in the trade for about an hour. They took a nice profit. Then they hit the road. So good question. My game plan typically is a bit more, hey, let this thing rally, and I'll kind of sit back and applaud it, and then look for my short. But there's certainly money to be made on those bounces. Moolah to be made. Let's just hope today's not a huge chop fest at 3,900. A little bit more than that today. But all right, guys, thank you for your time this morning. I always appreciate it. Yeah, today's Wednesday, so I will see you again for pre-market prep next Monday. And then I'm getting married in a few weeks, so we'll have to figure out the scheduling and all that. Yeah, I'm getting married 2 weeks from Friday. It is getting real. But all right, my friends, thank you for your time. I always appreciate it. Hope you found this helpful, and I will talk to you soon.